Eric Sabatini back with your Monday Mortgage Scoop. So another budget announcement has happened, and once again, the budget hasn't balanced itself, but this wasn't a surprise. No one really expected it to, or for spending to be kept in check, really, since it's not really a vote getter or a vote winner. I do see some long-term real estate and mortgage implications from this recent budget, so dive in with me for a bit. The budget wasn't actually as bad as many feared. The big news is the increase in the capital gains inclusion rate. But there's already a lot of misinformation about this. So here's what's actually changed. The capital gains inclusion rate has gone up from 50% to 66.6%. It applies only to the gains over 250K in a year for an individual. So let's do some quick math. If you had a $300,000 gain and were in Ontario's top tax bracket, you'd pay about 85K under the new rules compared to around 81K before the new rules. So it's a difference of like $4,500. It's not a huge increase. Nonetheless, do we want the government taking our hard-earned money? No. The budget makes some false claims, though. It claims that it only affects the wealthiest 0.14%. This is false. It actually affects corporations, meaning it impacts more than just the ultra-rich. Corps now have a 66.6 inclusion rate on capital gains with no 250K exemption. So they're taxed at the new rate from the first dollar they make. This affects brokers like me who are incorporated or anyone investing in mutual funds, since mutual funds are considered corporations. This is potentially leading to higher taxes on gains. So let's not pretend this only hits the wealthy. Many regular savers and investors are affected by this, all right? There's also a timing issue here. So I want to give you this example. Imagine there's a couple who owns a cottage they bought long ago for $75,000 in the Kawarthas. When they sell it after passing away, any substantial gains from the sale could face the higher inclusion rate in their final tax return. This could impact retirees with modest incomes, but have valuable assets like stocks, second properties, cottages, right? So it's not just affecting the wealthiest of the wealthiest. Here's my actual biggest concern with Canada's new budget. It's what I like to call the boiling frog theory. If you're not familiar with it, I do suggest you looking it up. But in a nutshell, it refers to gradually changing the temperature when boiling a frog slowly so that those gradual changes aren't noticed and the frog is actually being boiled to death. Now, from an economic standpoint, here's what I'm worried about. It implies that people will adapt to deteriorated conditions and not being strong enough to escape those conditions afterwards. So in Canada, until recently, taxing capital gains at 50%, it was a sacred rule. It was untouchable. Changing this rate was political suicide. But by introducing this rate change now, I feel that they're getting people used to it. They say it only affects the wealthy, but no one really defines who the wealthy are. And the biggest problem is, do we start with a 250K exemption now, but like the boiling frog theory, do we change it a little bit more after the fact? Do we exempt the first 250, but then we apply it to the next 250K and so on? Eventually, could we be taxing anything over $1 million at 100% to make the rich pay their fair share? It happens gradually, so most people won't notice it so long as the rich are paying more. That's my fear. I think that the government is betting on baby boomers selling off their investments soon, which could rake in a lot of tax revenue. But rich folks will just hire better lawyers to find loopholes and avoid paying more. Last time the government raised taxes like this on the wealthy, they actually lost money in the long run because the wealthy did this. The budget, recent news surrounding Canada's housing crisis, it's not just about taxes either. I feel it's about sending a message. Success and wealth aren't something to be proud of. They're actually something to be heavily taxed. So Canada's productivity is already low, and these tax changes will likely make things worse. I think it's also signaling to foreign investors, hey, guess what? Canada isn't a good place to invest anymore. Business dislikes uncertainty, and sudden tax changes creates a lot of uncertainty. Imagine you spending your life building a business and hoping to retire by selling it. Now the government is taking an extra 9% of your retirement fund with no warning or reason. Seems a little unfair to me. The government, as governments do, will probably waste the new tax billions on frivolous programs. Meanwhile, even with more taxes, the deficit is expected to grow by $40 billion this year. Even if a fraction of the top earners actually decide to leave Canada, we are going to have serious revenue problem if we're banking on taxing the wealthy. Now, from a mortgage standpoint, I am a little concerned that rates will stay higher for longer. If you study the bond markets as I do, you'll already see the bonds going up. It's investors signaling, I think, that there's a spending problem here, and we are going to need higher interest rates to take on the risk of financing Canada's debt. Will we see rates decrease soon? I still think we see a rate decrease come fall, but rates are not falling as quickly as economists predicted earlier this year. Perhaps it's because the money markets and investors, they're smarter than the government, and they see challenges ahead that need more solutions than simply dropping interest rates. You want to talk about this further? I know it's a little bit, critical of me. Drop me a line.